Hey everyone, welcome to today's video on diving into the world of exchange traded funds, also known as ETFs. These are such great investment vehicles that you can use alongside a mutual fund or a stock. And in today's world, there's so many exchange traded funds available out there. How do they work? And that's what this video is here to explain and to guide you on what options are available out there and what exactly an ETF is and how it differs from the other investment solutions like again a stock and a mutual fund. And one of the unique features about an ETF is that they trade just like a stock because they trade on a stock exchange. And they hold many different assets of stocks, commodities, or bonds. And they're very popular because of the diversification feature you get, similar to that of a mutual fund. And they trade like individual stocks. You can buy and sell on the market, whereas a mutual fund, you cannot. Now let's jump into the fundamentals of the ETF. And when you look at an ETF, think of it as a basket of securities that you can buy or sell through a brokerage firm on a stock exchange, like the New York Stock Exchange, or here in Canada, the Toronto Stock Exchange. And the great thing about these ETFs, and one of the reasons they're so popular, is because of their low cost, tax efficiency, and flexibility. And speaking of cost, ETFs are generally much cheaper than mutual funds. But because just like stocks who trade on exchange, there may be trading fees associated with buying and selling an ETF. Now, these can add up if you're actively trading. And because in today's world, there's so many different ETFs available out there, we'll take a look at each one and how they're different from each other, starting with passive and active ETFs. With passive ETFs, they're also known as index ETFs, they aim to replicate the performance of a specific index. These indexes can include many of the major benchmarks like the S&P 500, which we just talked about, as well as more niche indexes that focus on one specific sector, region, or themes. And one of the main goals of the passive ETFs is to match the returns of the chosen index rather than trying to outperform it. And because of that, they do come with some advantages. Those being low costs, because they're not being actively managed, they tend to have lower management expense ratios. Tax efficiency. Most passive ETFs, due to their low turnover rates, meaning investors hold them for longer periods of time, tend to generate lower capital gains distributions. And a result, what that means is that investor will have lower taxes. And then last, we have transparency. Passive ETFs will disclose their holdings regularly to the investor so they always know what they're holding. VFV, that is a great example of a passive ETF. On the other hand, we have active ETFs. And these active ETFs are managed by portfolio managers or a team of managers who have selected and try to trade securities in an attempt to outperform the specific benchmark and achieve their specific investment objectives. And these managers can use a lot of different strategies, those including market timing, fundamental analysis, and technical analysis to make their decisions on trying to outperform the benchmark. Now, there are some few advantages of active ETFs, that being one, the potential for outperformance. Because they're being actively managed, you do have the option of beating the benchmark in terms of performance. And then flexibility. Because you're not tied to a specific index, managers can adjust the portfolio based on what they believe the market conditions and opportunities to be. But there are some disadvantages to this as well that we should consider, those being the higher costs. Whereas a passive ETF is generally cheaper, active ETFs, because they require more management, they technically have a higher expense ratio. They also may trigger more capital gains taxes because of the frequent trading from the active management done by the managers. And then there's also the performance risk as well, because there's no guarantee that the active manager will actually outperform the market or even match the performance of the passive index. And an example of an active ETF would be the JP Morgan Active Value ETF, symbol JAVA. And a great way to look at that here is if we look at this chart, they have illustrated that this ETF JAVA has actually outperformed its benchmark, and that benchmark being the Russell 1000 Value Index. So this is a good example of an active ETF that has actually outperformed the benchmark on which it's trying to compete against. Then we have other types of ETFs that we can invest into, which come with a little bit more risk, but do offer some features and benefits to certain type of investors. Those ones being the leveraged and inverse ETFs. So let's look at the leveraged ETFs first. With these ETFs, they use different levels of leverage, typically 2 times or 3 times. And what this means is that if the underlying index rose by 1%, if you had a 2 times leverage ETF, your performance would go up by 2%. if you had a 3 times leverage ETF, it would increase by 3%. Now, in order for the ETF to achieve this, they use future contracts, options, and swaps to achieve this type of leverage. And because of this, they need to be actively managed as well to maintain their leverage ratios on a daily basis. So this is very, very different from the traditional ETF, but the opposite is true as well. If the markets come down, you can also magnify your losses as well. That is why this type of ETF is good for those who have a very high risk tolerance, have an understanding of the markets, and are comfortable with the risk of a leverage ETF. And some key things to think about when considering this type of ETF is 1, the higher risk, which I just mentioned previously. 2, the market volatility as well, because when things are great, it provides great returns. But when things are bad and the markets are going down, your losses could be magnified. The other would be the active management component. Because these need to be actively managed, this will typically have a higher expense ratio compared to the traditional ETF. And an example of a leveraged ETF would be the ProShares Ultra Q, QQQ, symbol TQQQ. What this does is it aims to deliver 3 times the daily performance of the NASDAQ 100 index. Let's look at that here as well. Let's look at that here now. So if we go down to this 30-day daily return chart, we can see in the dark blue here, the TQQ, which is this ETF, and then the light blue or light gray line, which is the NASDAQ 100 index ETF, which is its benchmark. We can see when things are good, this ETF performs well, and you get your 3 times leverage. However, when the index is down, your losses can also be magnified. So that is why it's very important that you do have the risk tolerance and understanding of these ETFs before making an investment decision to purchase one of these. And then finally, we have the inverse ETFs. These are also called short ETFs or bear ETFs, and they're designed to deliver the opposite performance of the specific index or benchmark. And for example, if the underlying index, let's say the S&P 500, went up 1%, the inverse ETF would go down 1% and vice versa. So how exactly does this inverse ETF work? They use various different types of financial instruments such as short selling, which basically means selling securities they don't own with the intention of buying them back at a lower price. And they also use derivatives, using options, futures, and swaps to bet against the underlying index. And because this strategy also requires short selling and derivatives, these inverse ETFs are also actively managed and need to be adjusted daily to maintain their intended inverse performance. But what would be a use case scenario of taking advantage of an inverse ETF? The first one would be hedging, protecting your investment in the portfolio from potential losses, or speculation in the attempt to think that the market might be on a decline. And because of this way these ETFs are invested, again, these are designed for short-term use. And just like the leverage ETF, these inverse ETFs come with some risks. Those being the risk of potential losses, which could be very, very significant if the index continues to rise, the volatility of the markets, because these are very sensitive to market volatility and can experience rapid ups and downs and price changes, and the active management feature. Because these need to be rebalanced daily, this can lead to higher expense ratios than your traditional ETF. And a good example of an inverse ETF would be the ProShares Short S&P 500, symbol SH. And the aim of that ETF is to deliver the inverse performance of the S&P 500 index ETF. And if we look at this chart here, we can see exactly what the chart looks like for this inverse ETF. Because if the S&P 500 continues to go up, this inverse ETF is going to continue to go down. Hence why it's a very risky strategy if your speculation is incorrect and the index continues to rise. And finally, that brings us to the end of this video. So if you stuck around till the end, I do appreciate you as always. Thank you so much. And I hope that this video gave you some insight into what an ETF is, how it works, and what available ETF options there are out there. And as always, I do kindly ask you to hit the like and subscribe button down below, and I hope to make more of these videos for you in the future. Thanks again, and we'll see you on the next one. Take care.